Welcome to ETF Market Insights, a weekly show focusing on the evolving world of ETF investing. Each Friday, a new panel of thought leaders aims to provide investment education and insights, with the goal of helping you become an informed investor. Make sure to visit youtube.com/ETF Market Insights to watch previous episodes. And remember to hit subscribe so you receive a notification when we post new content and when we go live each Friday. Thank you for joining us today. Let's get started.
Welcome back to ETF Market Insights. I'm your host, Erin Allen with BMO ETFs. And today we will be discussing a sector that, in my opinion, often gets overlooked, and that's utilities. These are really the companies that help us keep the lights on, so to speak, and much more than that. But we're going to take a look at some of the interesting factors that are at play in the market today, which may warrant you to have a closer look at this sector. But before we do get started, a quick reminder that we're not providing investment advice or recommendations. Today's show, as with all of our shows, is all about providing education around investing for Canadian DIY investors. With me today, I have Chris Heeks, Portfolio Manager and Director with BMO ETFs, and Colin Szynski, Portfolio Manager and Chief Market Strategist from SIA Wealth Management. So Chris, Colin, thank you so much for being here today.
Thanks, Erin. It's great to be here once again.
So different sectors have different return drivers, and the use of a sector rotation strategy using ETFs can be an effective strategy, and it's something that we've discussed on this channel before. So I wanted to kick off sort of with a look at our wheel that we've created, a sector wheel to really help you visualize which sectors you could look at across the different market cycles. So simply put, defensive sectors, also known as counter-cyclical sectors, include sectors like consumer staples, utilities, and healthcare. These tend to perform well during those recessionary or economic trough periods. And then we have our pro-cyclical sectors like discretionaries, financials, technology, communications, and so on. And they tend to do well when the economy is expanding. So again, today we're going to focus on utilities. So Chris, hoping you can kick it off today with a general intro to the sector. What type of companies can we expect to see in an ETF with the utility sector?
Yeah, thanks, Erin, and again, good to be here. So you kind of kicked it, you alluded it to it earlier. These are the companies that keep the lights on. Generally speaking, energy producers and distributors fall into the utility category. These days there's a lot about renewables. We'll probably talk about that. That's been a growing sector within utilities. The more traditional, would be more the gas-fired power producers or hydro operators, coal, which is still used quite a bit in the U.S., not so much in Canada, and more nuclear these days. But some of the names that might be familiar to investors, Hydro One, Fortis, Emera would be those kind of more classic rate-regulated utilities listed in the TSX, but increasingly, some of those companies have more North American and even global exposure. And then on the renewable side, a couple companies that might, just to name a couple, Boralex and Brookfield Renewables, couple companies just to name in that on the renewable side. But yeah, overall, the companies that keep the lights on, maybe, don't always get as much, they're not the NVIDIAs of the world, but some would argue equally important as well.
For sure. And then talk us through I mentioned that they are a more defensive sector, but walk us through some of the pros and maybe considerations around investing in this sector. What does it really add to a portfolio?
Yeah, I think the big pro is, you mentioned, utilities are less sensitive to economic conditions, to the economic backdrop, kind of regardless of what's happening. As people, we need these utilities to be running, we need the power on. So it's much less economically insensitive. It'd be just about the most defensive sector you could get in equity investing. So, that ability to have a growth exposure of equities is good, but being less sensitive. Of course, that pro kind of comes with the con embedded in as well. If it's less sensitive, investors acknowledge that, and the growth profile again on a utility is not going to be like the growth profile on your average tech company. But again, investors are drawn to that defensiveness and also income as well. So, ZUT is a BMO utilities ETF. It's distributing about 4.5% net. Doesn't sound like a lot when fixed income was over 5, but now, as we know, those fixed income rates are starting to come down. And it's expected that equity dividends, which utilities characterize, as a dividend-paying sector, are going to look more kind of relatively more attractive. So investors use it for the income. They use it for defensiveness and tactically as well. And again, with the interest rates coming down, that's certainly going to be a tailwind for the sector, whereas it's been more of a headwind the past 2 years.
All right, and talk us through a bit more in terms of how it's looking today from a fundamental perspective for the sector.
Yeah, I think it's looking better and better. The big story, kind of absent 2022, has really been about equity growth. And if you look at the U.S. for a second, it's been all about technology. Again, technology hit a bit of a patch of weakness in 2022, but it's been full steam ahead kind of ever since then in the past year and a half, 2023 into 2024. And, a couple things have come along with that, obviously higher interest rates as well. And I think both that market sentiment towards higher growth as well as those higher interest rates, had people saying, maybe they don't need the utilities right here, right now. There was more attractive segments of the market to invest in. And, as a consequence, some of the valuation ratios are looking quite a bit better than they would have looked 2 years ago. Forward price to earnings is well under a 10-year average. The dividend yield that I mentioned, that's well above a 10-year average. And again, looking more attractive as fixed income rates look like they're decreasing, especially here in Canada. Price to book is looking attractive, and so there's many valuations that are metrics that are looking more attractive, and so I think a little pause in growth would probably benefit utilities, and investors maybe are overlooking the sector for growth right now, but we'll see how the rest of 2024 shapes up. It's certainly more attractive, and I would say we are starting to see investors rotate into it to take advantage of that attractiveness. On the ETF side, one of the great things, being an ETF portfolio manager, is just seeing where all the flows are going. And certainly we're seeing that happen both in Canada and the U.S. In the U.S., the utilities is the top sector, just behind tech over the past, call it a month or so, for flows. Well kind of ahead of a lot of other sectors. So they're starting to see, and I know Colin's going to get into the technicals as well, of course, but we're starting to see the attractiveness of the valuations. Perhaps it's a better time for utilities to come out, and we are seeing that in the flows.
Yeah, thanks for mentioning the flows. I think that's an important thing that we used to look at a lot more on this channel, and I think we should probably make it a focus going forward. But it does tell us a lot about sentiment in the market, and something that we look at really closely when looking at content for the channel and that type of thing. Colin, thank you for your patience. Your expertise is in technical analysis, so Chris has covered off the fundamental side of things, but hoping you can provide us with a look at the technicals for utilities, and maybe starting with the more traditional patterns that might draw someone's attention to this area.
Certainly, and thank you for having us on today. I'm looking at the utility sector, and it's quite intriguing because there's two main drivers for utilities in the context of the stock market. One of which is that they're sensitive to swings in interest rates, and they're also sensitive to swings in risk appetite among investors. As you and Chris noted, they're more seen as more of a defensive sector. And as I look at this long-term chart of the BMO Equal Weight Utilities Index ETF, that we can see that in 2020, Originally in March of 2020, the utility sector sold off with the overall stock market. That was a period when just about everything went down. And then, but because of that, central banks cut interest rates really aggressively. And as an interest rate sensitive sector, the utilities turned around and soared right through the end of 2020 and then kind of continued to carry higher at a more moderate pace. When we got into 2022, people started to get to be more concerned about rising interest rates. But at the same time, we had a sell off in the stock market, and utilities benefited for the first part of 2022 as a more defensive sector. But then, as the rate increases continued, it caught up. And then we saw towards the end of October 2022 through October of 2023, utilities underperformed. They fell back. Rates were high. The interest sensitive side took over. And it was also a time when the stock market was soaring. So investors rotated out into more aggressive growth sectors rather than the defensive areas. Since October of 2023, when it was November the 1st when the Fed started to pivot towards being done raising rates and people started thinking about rate cuts, then since then we've seen the utility sector and other interest sensitive groups like real estate stabilize, and they've held above their long-term trend lines, and more recently we've seen utilities start to pick up again, and so what we did see this month was we saw interest rate cuts from the Bank of Canada as well as from the European central banks. So not only does it look like central banks are done raising rates, but some of them at least are even prepared to start cutting. So as an interest rate sensitive group that moves opposite to interest rates, with rates coming down as a positive for the utility sector. We've also started to see a little bit of defensive flows in the market as well. We saw a big rally in gold earlier this year, and we've seen as the market rally has progressed that the gains have been concentrated among a smaller and smaller group of stocks. So while some sectors have continued to do well, others have started to weaken, and some of that capital may be rotating into utilities as well.
Fantastic. Thank you for that. And then at SIA Wealth, your specialty is relative strength analysis. So I want to get to that too. So maybe you can give us a brief intro for those of us who might be new to technical analysis. What is relative strength analysis? And then have a look for us at the utilities sector from that perspective.
Absolutely. So when we look at relative strength, there's two ways that people will look at it and SIA takes advantage a bit of both. It's how is a stock performing relative to the market, or how is a stock performing relative to another asset. And at SIA, we look a lot of we run billions of calculations every day in terms of head-to-head battles between stocks versus other stocks, stocks versus commodities, commodities versus other commodities, indices, bonds. And by looking at all these head-to-head battles on price and counting up to see who the winners are and how this evolves over time, then we get to see which areas are attracting capital, are moving up in price, and which areas are losing capital and seeing capital move off into other areas. And so we take these battles and then we rank sectors or stocks based on who's winning the most battles within a universe. So within the sector universe that we cover, utilities has been one of the stronger moving groups upward over the last month or so. It was down in the lower half of the ranking table for most of the last 2 months, but it's now picked up back into the other half and is steadily working its way higher. So it does appear that that utilities are starting to attract some renewed interest. Another way we've looked at this is also on the actual charts we can see. And this first chart we have is the Canadian utilities sector versus the Canadian market. So we have the S&P TSX Composite Index in orange and the BMO Equal Weight Utilities Index ETF in black. And we can see from the September of 22 to the about October of 23, even it was in a fairly steady downtrend, utilities, where the market was flat and utilities were actually dragging on the market. We then saw from about October 2023 that the utility sector bounced, kind of came back and corrected, and then rallied again. And it's now broken out of a downtrend, and it has started to definitely attract some renewed interest. In contrast, we saw while the while the utility sector in Canada was base building, the TSX was picking up, getting driven by tech, driven by energy, driven by materials. More recently, we've seen the TSX composite look like it might be topping out a little bit. It's kind of broken an uptrend. It's kind of gone from upward trend to sideways trend, whereas we've seen the utilities go from downward trend to upward trend. So it does look as though in Canada, the utility sector is starting to recover relative to the rest of the overall market, and that may be part of a defensive movement in capital.
And how does that compare to the US?
In the U.S., we like to look at the performance of the three Dow Jones averages. The Dow Jones Industrials on this chart are in black, the Dow Jones Utilities are in orange, and the Dow Jones Transports are in purple. And generally speaking, over the longer term, these three indices are what we call fellow travelers. They do tend to generally trend in the same direction. But we've seen some more divergences more recently that have been interesting. So the first one was that in the fall, we actually saw the utility sector turn up before the overall broader market did, which was quite intriguing. In the utility sector bottomed out at the end of September. The industrials and transports bottomed out closer to the end of October, and then all of them kind of carried up into the end of last year. And then through the first part of this year, we saw utilities stall, and the other two, the industrials continued to climb, and the transports consolidated at a higher level. More recently, what we've seen since April is the Dow Jones Industrials have leveled off. Other indices such as the Nasdaq and the S&P have carried on to new all-time highs, and in April and May, we saw a significant improvement in the utilities sector. A lot more interest starting to come in. They've had a bit of a correction more recently, but the other interesting one is the transports. And the reason is that most people have felt over the last 100 years or so that the transports should confirm move upwards or downwards in the industrials. So we had the industrials break out to a new high, but the transports did not. And that was a non-confirmation. And then even worse, not only did the transports not confirm, they actually turned downward and started going in the opposite direction. And interestingly enough, when we saw the transports start to come down, coincided with the utilities taking off. And that suggests that we were starting to see more of a defensive shift in sentiment and a defensive turn in capital flows.
Interesting. And then on the subsector level, is there anything to note in terms of the subsector level of utilities in terms of what's looking attractive?
Sure. At this point in time, for the most part, utilities are kind of just starting to break out of a base. They've been down and depressed for quite a while, and they're just starting to turn up. So we haven't seen everything turn up yet, but there are two subgroups that have been leading. In the United States, it's the big cap electric power generators, and that's not a surprise. When a sector tends to start into a new trend or a new direction, it is the big caps tend to lead, and then the smaller caps follow generally later on. So we're seeing big cap U.S. electric producers doing extremely well, and we're also seeing in Canada, it's been the pipeline stocks. The pipeline stocks in Canada have started to break out. The electric utilities have started to pick up, but they're not as far advanced as the pipelines.
Awesome, thank you. And then Chris, bringing you back in here, we've talked a lot about interest rate policy and how that can sort of be a driver for the sector. Are there other themes that you like for this sector right now?
Yeah, there's a few other themes that are pretty interesting. One thing there's a lot of talk about renewables. When Biden passed his Inflation Reduction Act, it was kind of funny because most of it was kind of more directed towards renewable and clean energy than it was really reducing inflation. That's obviously a mega trend that's playing out, with 2050 commitments. And renewables are a big part of that and are forecasted to really grow, as a share of power production, grow quite a bit. I think that's interesting for a couple of reasons, but, one of the things that's neat is in ZUT, we use the equal weight methodology. And so if you look at the equal weight methodology versus the market cap, we're a bit overweight renewables in ZUT. So I think long term, that's going to give ZUT a little bit of a tailwind versus the index, given we're seeing more expected growth in the renewable space. Another space that's interesting is big data and AI. You thought you came to a utilities call and you could escape AI, but unfortunately, no, you cannot. You can't. Everywhere you go, it's AI, and obviously, the AI, the engines need fuel, and electricity is that fuel, and not just AI, but data, data warehouses and data centers and those needs. So if you look at actually the overall electrification needs, we've started to kind of level up. And even with AI, a lot of forecasts in that kind of longer term horizon, 10, 20 years, have started leveling up with. So we thought we knew how much more electricity we were going to need, but then came electric cars and now came AI, and some of those things are getting leveled up. So, kind of like the medium term forecast is around 3% growth in the electricity needs. And it doesn't sound like a lot, but that number was more like 0.5% to 1%, a few years ago. So it's almost like a tripling. So I think that's going to be a bullish story for utilities that plays out. The macro backdrop is it's going to play a significant role. Colin said it very well. The risk appetite, playing a role. If Nvidia just doubles every 3 months, then maybe what do you need a utility for? But I think maybe there'll be some opportunity for utilities, especially with a lot of risks in the market, I think, this year. And interest rates, we mentioned, we had one cut in Canada. Market's pricing in another 2 this year, a little bit over 2 actually. So that'll be interesting to see as well. So, but yeah, overall, the renewables and that big data and AI, I think, and just the electrification needs overall are driving some good fundamentals, and I think should also help provide a tailwind, as we look forward.
Yeah, it's a pretty compelling story. All right, take us home with how you can get access with BMO ETFs to the utility sector.
Yeah, so we got 2 sector ETFs. One, ZUT, we've mentioned quite a bit, which is equal weight utilities index ETF. So it equal weights the TSX listed utilities. As I mentioned, it's got a little bit of an overweight to renewables. I like that long term. Now there is a little bit of risk with politics, as always, and regulations, but long term, I do like that exposure. That I would call a pure play sector. Then we have the ZWU, which is the BMO Covered Call Utilities ETF. This one is a little broader. It's utilities in name, but it also includes pipelines that Colin mentioned, as well as telecoms. So it looks for those very economically insensitive sectors and subsectors to supplement the utilities. It also has exposure to U.S. listed. It's got close to 40% in the U.S., so it's like a 60-40 Canada-U.S., so it's a little broader in scope. And then with the cover call overlay, obviously, is more of an income product, so that's attractive. And again, as fixed income rates decline a bit, having that 6.5-7% type yielding product is attractive. So those are the 2. And then just beyond that, one quick word for low volatility, which I'm sure we've discussed on the channel here a couple times. And so, the low volatility strategies are more broad, but they are overweight the defensive sectors and are quite overweight utilities as well. So, if you're liking the sound of defense a little bit, but want something a little bit more broad, I'd say think about low volatility. So that would be ZLB is the BMO Low Volatility Canadian Equity ETF. And then in the US, we've got ZLU, so the BMO Low Volatility US Equity ETF. So again, overweight utilities and overweight defensives overall within those strategies.
That's great. So you got ZUT for the plain vanilla, ZWU for the cover calls, and then the low vol for a more diversified approach if you're not ready to go all in on utilities yet. Love it. All right. Well, thank you so much, Chris and Colin, for joining me today. It's clear there's a lot going on with utilities and a lot of tailwinds at play, but I appreciate you taking the time to be with me here today.
My pleasure.
Thanks for having me.
Thanks to our viewers for joining us today. If you do like the channel, make sure you subscribe and please spread the word. Share it with your friends and family so that they'll join our community as well. It's important for us in order to continue providing this level of education to you. But that's all for today. There is no episode next week because it is Canada Day and it's a long weekend, but we'll see you next time. Bye for now.
Thank you for watching this week's episode of ETF Market Insights. To stream any previous episode of ETF Market Insights series, please visit youtube.com/ETF Market Insights. Remember to hit subscribe and sign up for alerts so you know when we post new content. Also, we invite you to visit our accompanying website for ETF tools, education, and much more at etfmarketinsights.com. Once again, thank you for watching. The session provided is for information purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or recommendation to buy or sell. Particular investments and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to any circumstance.